Good evening, everyone. Welcome to tonight's webinar. We've got a fantastic panel. For those who don't know who I am, my name is Dagan. I'm the Executive Director of Peak Asset Management. And we're fortunate enough here to have David McNamee from Altor, Ron Shamgar as well from Tamim, Steve Torso, CEO and founder of Wholesale Investor, and Rudi, all the way from FNArena. Now, a lot of topics to discuss today. So the format of the webinar will be, call it running. And then we'll ask the panel a number of questions. There's a live Q&A button down the bottom of your panel down there for everyone that can ask questions. So we will try and be about an hour. So the format as follows. So any questions, please type in the Q&A below and we'll do our best to answer. So guys, we'll kick this off. Seeing huge amount of volatility. The Nasdaq's down about 30% since the peak. We've seen high inflation rates at close to 10%. The Reserve Bank saying inflation here is going to be close to 7%. It's a little bit of fear and greed out there. Ron, maybe I'll go to you. Tamim Asset Management, tell us a little bit about you and your background and how you're seeing the market.
Yeah, sure. We're Tamim Asset Management. We're a boutique investment firm based in Sydney. We offer clients equity market exposure through a couple of funds, which I manage. We also have property funds and a credit income fund as well. I've been investing in the markets for the last probably 19 years. So I've seen a few cycles. Each time it's a little bit different. I think this time, it's obviously interesting, and it's definitely been a tough calendar year to start with. It's been quite volatile. So it's definitely we do tend to sort of adapt our portfolios based on sort of what's happening, but it's definitely been a tough year.
David, not sure if you can hear us now. Tell us a little bit more about Altor and yourself and your background and how you're seeing the market yourself over the last 3 to 6 months.
So Altor's we've got an alpha fund, which is basically we're focused in on the sub 100 mil market cap sector within the Australian stock market, and also we can take up to 20% of the fund into private pre-IPO investments as well. And it's quite a flexible mandate, but we're really looking for asymmetric risk return profiles and things that we can see some downside protection within the investments, but then there's catalysts to drive significant value as well within the price of the shares. Just reiterating what I caught the back end of what Ron was saying, and I think I was mentioning it before, but I've probably been investing for about 10 years in the equity market, and we've had overall it's been a pretty good time during that period, but the last 2 years in particular has been, you've had COVID was one of the biggest market corrections in terms of the largest correction in the shortest period of time. And then we had, the Nasdaq almost went up 2.5-3 times from the low. So it went from almost peak fear during COVID to what, there were some pockets where there was definitely some peak greed in the capital markets. And then now, all those things that have done very well during that period have come off sort of anywhere from 50 to 90%, particularly in the growth equity space.
Yeah, we'll come down to that, to a little bit of stock specific questions. Rudi, you're a market veteran. Tell us a little bit about FNArena, what you're doing and what you're seeing out there.
Well, thanks, Niv. But if you have noticed, I'm not wearing a grey beard, so I'm not that old yet. But I'm the founder and editor of FNArena, as you can see behind me. This firm started 20 years ago, so yes, there was some experience here. I'm probably fair to say we are one of the very few truly independent online financial media focused on the ASX. Probably fair to say we provide proprietary data, independent journalism, and independent research. And ever since late last year, in particular in 2022, I have presented myself as a cautious investor, and I think that view has been correct so far. I think we should remain cautious investors for the time being, because on my analysis, bear markets are not that uncommon, and they do not necessarily last very long, and they definitely always last shorter than a true bull market. But I do think that I'm sure we'll go and talk about this a little bit more. I do think this one has the potential to last quite a lot longer than where we are so far. It's a case of not losing too much money, I think.
Yeah. And Steve, you've been in markets for a long time. I mean, we go way back. Tell us a little bit about Wholesale Investor. Obviously, you're more focused on private companies and unlisted innovation. It is global. Tell us what you're seeing and how you're sort of faring in the markets right now.
Thanks, Niv. Yeah, so Wholesale Investor is a platform that connects high net worth investors with emerging growth companies. And also we do work with small caps as well. And, like exactly, for me, I think this period reminds me of when we actually launched the company sort of back in 2008, where effectively, you do have a lot of people that are actually sitting on the sidelines at the moment, trying to understand or trying to see how things play out. And in our space, you've gone from seeing these record multiples and valuations that have been achieved by companies where some companies were doing sort of 100x, 200x of revenue in their capital raisings, to all of a sudden that's been wound back to 5 times, right? And that's been a massive shock to the system. And then also you're watching venture funds where they've gone from being aggressively trying to raise new funds to consistently be putting money into businesses, to now they're basically sitting on the fence, supporting portfolio companies, and effectively only looking to go into, some of their star performers. And likewise, from a media aspect, I think that's another important part, because that sort of plays a role. You've gone from hearing nothing but companies raising, success story, to all of a sudden it's now like literally, if you go have a look at the traditional media in the sort of startup, it's like the capital raising is now moved out, and it's more about who's cutting people today. So it's announcements of job losses that is becoming more prominent across that. So it's been fascinating. I personally haven't seen a transition happen that quick, and it's really deteriorated in the sort of first 6 months of this year.
So a question that is in everyone's probably tongues and wanted to ask, and probably directed more at Ron and David as portfolio managers. Have we reached the bottom?
Yeah, sure. Look, it's a it's $1 million question. I think it's obviously you never know exactly when the bottom is, but if you look at sort of the last sort of 40, 50 years of bear markets, we looked at some data. I mean, the average bear market, which is essentially a drawdown of minus 20% or more, usually lasts for about 140 days on average. So we picked it sort of mid-January, I think. So we passed that point in terms of the average length of a bear market. So you could argue that maybe we're closer to the bottom than the top. And there's another few sort of metrics to kind of keep a watch. If you look since the 1980s, for example, the average bear market hasn't bottomed until we have 3 relief rallies of at least 10%. And, if you look at this bear market, we've had 2 relief rallies of sort of barely 10%. So if you kind of compare that, we're not there yet. And then there's another measure to look at. For example, there's a thing called the volatility index, which is the VIX. It's been around, I think, for the last 30, 40 years as well. And we never had a bear market bottom until the VIX hits 45 or higher. I think we've hit 38, 39 this time around. So again, you could argue that, we could see a bit more sort of bearishness. If you look on the flip side, if you look at consumer sentiment, we've seen the numbers come out in the US, record all-time lows. You look at investor sentiment and, cash weightings of money managers out there. Again, very, very sort of bearish sentiment and high cash weighting. So as Steve mentioned, I think investors are sitting on the sideline. They're not sure when they can come back in. So I don't think we've reached the bottom yet. It's probably, funnily enough, probably when we hit a recession, official recession, I think maybe that could be the bottom. But I think really investors want to get a feel for how high interest rates go and how hard a recession will be, and will there be a recession in the US, which is the most important market.
David, what are your views? Very, very good insights there, Ron. And just for those at home listening, the volatility index really is a measure of options. And look, you can actually check it out on the chart on VXX is a stock code, but looking at 45, that's an interesting barometer. David, what are you seeing there? Have we reached the bottom?
Look, I mean, the sector that I focus on, we're very much focused on, the fundamentals of the companies. And I think you've got to look at different asset classes. Growth equities, I think, have been in a bear market now for probably close to 8 or 9 months. Whereas you've probably only seen some of the bigger cap, obviously the NASDAQ's also been in a correction period for a while, but the Aussie market, more generally the bigger stuff's only really rolled off towards the sort of latter end of the first quarter of this year. We are seeing sectors where I do think bottoms are starting to emerge. And June has been a very brutal month with tax loss selling, particularly at the smaller end of the market. So there are a lot of things trading under cash now, trading under asset backing. I was looking at even today, I was looking at, for example, Touch Ventures that's trading under cash, not even including any of the investments that they've got on the books at the moment, and going through some big volumes going through the shares. So I think particular areas, probably a bit of technology. Obviously you've got to be careful there, given some of the capital requirements that those companies have. But the biotech sector in particular, particularly offshore and here, a lot of things trading under cash backing. So that there are a few things where I think there is a bottom starting to form. I think the volumes will probably die off over the next little period, and it will take a bit of time for sentiment and momentum to turn around again in the sector. But just following on from what Ron says, I do think it's really going to be how the consumer sentiment and demand, how does the demand side from consumers flow through over the next 3 to 6 months, and how does the central banks across the world respond to that? Because obviously everyone's dealing with supply side issues, but it's just the demand side part of the equation. The issues that are coming through there haven't really come to the boil yet, I don't think, in the numbers. So yeah.
Now, some good insights there. I want to rewind to the 1970s, because there's some, when we were sort of investing during the COVID era, it was a big blip, but it was one of the biggest upticks we've seen, and investors like us all made significant amount of money. So 2020, 2021 did a lot of capital raises, a lot of IPOs, a lot of investing, and everyone made a lot of money. So I want to rewind to the 1970s, which is a period of low economic growth and high interest rates, high inflation. Rudi, do we have any correlation between the 1970s and a period of what's known as stagflation to where we are today? And also, what should investors be doing? What are you seeing in terms of asset classes that have outperformed? Because I know from looking at history, the 1970s, gold and commodities and energy were really the standouts in terms of asset class performance. So, Rudi, a question to you on the 1970s relative to where we are today.
First up, I don't think we are going to relive the 1970s. And second point is, I would say that we all hope that we are not going to relive the 1970s. And the reason for that is the 1970s were not kind to equity investors. Just talk to any fund manager that in those days had to actively manage a fund, and they probably still have nightmares about it. What we also should realize that in that environment, the share market simply doesn't work. I mean, you really have to go in fixed interest, basically. The only thing that did work in the 1970s was, as you pointed out, Niv, was gold, and that's because inflation was high. Inflation could not be tempered. Inflation kept coming back, and in an environment where investors have the impression that the central bankers do not control inflation, they seek for an alternative, and that becomes gold. Gold pretty much went up 20-fold in the 70s. and ultimately peaked at $830, which was at that time was very, very high. But gold also got slammed afterwards when central bankers successfully constructed two back-to-back recessions in the US in the early 80s. And that, of course, brought then back the bull market for equities. I've been passed over for the previous question, but I think one observation needs to stand out. Apparently, markets do not bottom before central bankers reverse course in general terms. And I don't think this lot of central bankers at this point in time is of the mindset that they need to reverse course anytime soon. And so I think we all have to be prepared that this could last another 6 to 9 months from here. And that's why I keep telling to people, don't be impatient. Make sure you have enough cash on the sidelines. And in particular, don't underestimate the fact that as inflation has surprised so far, if inflation keeps surprising, then maybe you should have some gold in your portfolio. Having said so, that is not the same as having gold in your portfolio through the share market. Whether we have a recession coming up, an economic recession, I think is by the by. What we will have is an earnings recession, both here and in the US. And I think as a share market, ultimately is all about corporate profits. I think there's where the challenge is for investors over the next 12 months or so. I mean, this week we had positive results from Metcash and from Collins Foods. Share prices, both cases responded positively. The problem in both cases is how are these profits going to look like in 6 months or in 12 months' time? And that, I think, is the big unknown. Housing markets are almost by definition going to correct because interest rates are going that high that quickly. But that's a gradual process. The consumer is still buying today, but will they be buying in 3 months' time, in 6 months' time, in 9 months' time? And I think that's the big question mark, and that's the big challenge for investors today in the share market, I believe.
So, and just on that, Rudi, do you think the demand has been pulled forward during the COVID period?
That also has happened, and I think if anyone has made an error coming out of COVID, that would be the one, I think. And that both goes for people who run those businesses as people who analyze those businesses and were investing in it. And that is one of the reasons why we almost by definition are going to have an earnings recession, because margins coming out of COVID, margins have been artificially pumped up, basically. And if they then come down to normal levels with challenges on the top side, that can be no less than a lethal combination. And just to highlight one of the risks that obviously is apparent in this market as well, we had BWX coming out with a very surprising, sudden, unexpected capital raising, which is obviously extremely dilutive. And this business deteriorated in a number of weeks, and then all of a sudden had to raise capital. And of course, that's the problem when you are in that particular part of the market, and that's a risk that not many people talk about. But it'll come up much more in much larger numbers, I think.
Rudi, I think the real reason you don't want to go back to the 1970s is because you don't want to wear flare pants again, right?
I had thought that would be my joke. Yes, we were all wearing blue jeans in those days.
Hey, Ron, I wanted to ask about the P and the E, the price to earnings ratio. And we've seen stock prices around the world down about 20, 30, 40% in the indices all the way, as David said. Some stocks he's seeing down as much as 80 to 90% if you look at the buy now, pay later space, for example. We've got a very, very important week or two coming up with the E in the US reporting season. And then we've got obviously the Australian reporting season following that. So do you think that the E is factored in terms of the earnings? And is Rudi saying that if the earnings do fall, what impact will that have on stock prices?
Yeah, look, there's definitely been a PE, a multiple compression in the last few months. If you look at the Australian market, the long-term average PE of the Aussie market is about 14 times, and we're trading at the moment. If you look at the US, the S&P 500, it's about 16 times PE, the average, and we're sort of trading around there at the moment. So you could argue that valuations are fair, but there's two extremes to that. So obviously, we've seen savage sell-offs, as you mentioned, in that sort of more growth stocks that were trading on crazy multiples. Some of them didn't even have PEs; they just had a revenue or a sales multiple of, I think like Steve mentioned, maybe on the market it wasn't 100 times revenue, but definitely 10, 20 times sales multiples. That's really come down now. We're seeing a lot of pretty good quality technology names, more in Australia, that are trading on 2 times revenue. They're not making money yet, but they definitely have a significant amount of revenue. So we've seen that compression. And then, in the profitable space, there's a lot of companies that are trading on single-digit multiples, paying really good dividend yields. So they've seen a huge compression as well. So I think there's definitely, as Rudi mentioned, I think the economy is going to weaken over the next 12 months as central banks essentially are trying to put the economies into recession to try and reduce that inflation and, slow down credit growth, reduce consumer spending. We had retail sales for May come out today, and, consumers in Australia, they're still spending. We've got record low unemployment here and in the US, and we've got the highest job participation in Australia's history. So, talking to companies, we can all see that everyone's got labor shortages. They're very difficult to source labor. So, consumers have got incomes, they're still spending, but as rates starts rising over the next few months, and the cost of living has increased, I think we're going to start to feel that. I think companies like BWX maybe have some other issues, but definitely I think retailers will start feeling it. And so it's going to be more of a stock pickers market. I think if you look at the last 5-10 years, passive index funds are going to struggle in the next 5 to 10 years. It's going to be an active sort of managers market where you have to pick companies that can still grow earnings. I think we've benefited over the last few years, both in terms of earnings growth and we've had price PE multiple expansion. I don't think we're going to see that multiple expansion anymore. So for share prices to go higher, I think that earnings has to grow. And I still think there will be companies that will grow those earnings, but you're going to have to pick the right ones. So you're going to have to navigate that more carefully. Whereas in the last few years, you could have pretty much bought anything and you've done pretty well.
Yeah. Steve, going back to private companies more specifically, what are you seeing there, not only in Australia, but overseas? And how are you accommodating that to managing founders' requirements and call it innovation? And so what are you seeing and how are you managing the companies, the private side at the moment?
I'll give you two different perspectives, Niv. So I'll go from the first one as far as typically, so in our space, there's obviously a lot of high net worths that typically operate and invest into emerging growth companies. And typically the kind of investors that will invest into emerging growth companies, they're also the investors that will be investing into small and mid-cap tech companies, right? Or the innovation companies that are listed in Australia and also in the US. They're also the ones that are investing into crypto markets as well. So when you're seeing each of those that are coming off from a 70 to 90%, effectively it does, sometimes it does create that sort of pause for some of those investors that were passively investing into growth companies. So that's the experience on the Australian side about how that translates to some of the innovation in the private space. I think the other interesting perspective is from the fund managers, so from the VCs perspective. So I'm in Singapore at the moment. I've been having conversations for the last 3 days, and pretty much the feedback from the majority of them is it hasn't really impacted Singapore too much, but really they're still taking the guidance that's been given out by pretty much the UK and the US VCs, where what they're looking to do is they're actually explaining to their companies that previously, the guidance was that you should look to have a good 2-year runway. They're now communicating that they should look to have a 3 to 4 year runway because this could effectively be a period of 2 years of difficulty for innovation companies. And that then really starts to change the dynamic as far as how businesses start to think about their runway, their obviously their business model, etc. So the guidance from all of them is that, a year ago, 2 years ago, it was all about grow as fast as possible. Don't worry about, you keep on saying the E, Niv, don't worry about the E, just focus on the R, right? Just focus on revenue. And now it's, okay, how are you getting to profitability in the next 12 months? And it's amazing to see how fast that has changed. And not only you guys are mentioning over sort of just this year, I mean in the last 2 to 3 months. And I think what you'll find is some of the funds will use this as an opportunity to effectively get larger stakes in some of their higher performing companies at significantly, and some of their better performing at significantly lower valuation. So I think the perspective is that this is effectively an investor's market. This is what they've been, for everyone that's been sitting on the sidelines, said for the last 2 years, thinking this market's too hot, at some stage it's going to come off. This is effectively what this is the market they've been wanting to for a period. So I think there's that two parts of, there are going to be more people sitting on the sidelines, but also some of that money that has been sitting on the sidelines for the last 12 months that did very well in that sort of run up is going to be looking to deploy, but be very, very active. And they're going to be looking for business models that are getting close to profitability or will be profitable in the next 12 months.
Yeah, I think investor mindset's definitely changed, and we're seeing that as well here at Peak. I mean, gone are the days where, take the buy now, pay later space or some of the technology companies that were trading on earnings and multiples. It's really how quickly can you move to cash flow positive? And we are also seeing some down rounds, and I suspect that you're seeing that in the private space. David, I want to turn your attention to you, mate, just in terms of your portfolio and just talk us, and obviously this is all general advice, information only. It's not personal advice for those listening. What are your favorite picks right now? And maybe a question to Ron. And then what we might do is open it up for some Q&A. Down the bottom, there's a few questions. So, David, over to you, just in terms of what are the best sort of 3 or 4 conviction calls, and maybe for you as well, Ron, right now.
Yeah, I think you've got to just stick with things that have a really strong tailwind, Nev. And so for us at the moment, I'd say one of the standouts in our portfolio is Close the Loop Group, CLG, which is listed. And I mean, that company has very strong ESG tailwinds behind it. It's got very tier 1 customers in terms of it, making a solution that fits into what all the corporates are looking for within that recycling and circular economy space at the moment. So they've got a very strong value proposition on technologies that they've been building out within the business for a number of years. And it's run by a really strong group of management team that I've known for a while. And, they've had very good prior history in terms of finding the right acquisitions, integrating the right acquisitions, and making sure that it fits into the overall business as well. So I think that it's in a really strong place in terms of its earnings. It's in a really strong place in terms of the sector thematic that's going to play out. And I think there's a really strong pathway forward for them in terms of acquisition opportunities, particularly in the US. So I think that's probably one of the standouts at the moment that I can turn to, and within the portfolio.
Ron, what are you liking at the moment in terms of when you're looking at your portfolio? Are you adding to some of the stocks that are down right now? Are you looking for new opportunities? What are you currently doing with your portfolio at Tamim?
Yeah, sure. I mean, we're always looking for new opportunities, and I think that you can't just stand still and hope that things will be okay. I think you have to adapt to the circumstances, just like we adapted to the COVID and the lockdowns and then the reopening. I think we're adapting to this sort of new environment, higher interest rates, and an inflationary environment. So, by the way, we own Close the Loop Group as well, and I think it's a really good business, and we like the founders as well. So I agree with David on that. I think there's a few stocks that I think are actual beneficiaries in an inflationary environment, both from just higher transaction volumes that they clip the ticket on, or actually benefiting from rising interest rates. If they hold a float of money on behalf of their customers and they actually get to earn interest rate on that, well, in the last few years they've earned zero, but suddenly it starts to really come in. Every 1% rise, they really make real profits from that. So, just a few companies. So there's a company called Early Pay. The code is EPY. So essentially, they're the second largest non-bank invoice funder in the country. They do about $2.5 billion a year of invoice funding. And the good thing with invoice funding is they essentially clip, a couple of percent on their customers' invoices. And now these are usually sort of small to medium-sized businesses in Australia. And, with all the sort of government support and stimulus for businesses finishing in the last few months and going into a tougher economic environment, I think businesses will require more funding solutions. And these guys are seeing that demand accelerating. They're very profitable. They're going to make about 15 mil of net profit after tax. They pay you a 7% dividend yield, and they trade on an 8 times PE. Now, the good thing is if we have inflation, the average invoice amount is going to increase. And so naturally, Early Pay is going to make more money because they just clip a percentage of a higher value as well. So that's one that we like. Another one is a company called People In. So PPE is the code. They're essentially a workforce management business. So think about a recruitment company. We really like this business, been listed for the last 5 years. They've grown organically and through acquisitions, and they're operating sectors that I think are relatively resilient: accounting, healthcare, nursing. And they also have some IT, and we know there's massive shortages in skilled IT labor. And they recently made an acquisition of a business that essentially brings Pacific Islanders employees into the food and agricultural sectors. And we know there's massive demand for that. So the good news, again, they clip a ticket, a percentage of the wage of the staff that they place into a company, and they get to clip that ticket ongoing. So I think, if we have wage inflation, which we are seeing, and, wages have gone up, then People In will make more money as well. Again, trading on a PE multiple of 7 times next year, paying you a 5-6% dividend yield. So these are the kind of businesses that we're looking at that are going to benefit. And then there's other businesses like, for example, life insurance company Clearview Wealth, CVW. Profitable business, life insurance, has a really strategic position in the Australian market, 7% market share. And their possible takeover target, they're going through a strategic review because their largest shareholder, Crescent Private Equity, is exiting. They're trading on about 13 times PE. But the good thing is they've got they hold all those policies that their customers, they hold that float, which is about $350 million, and they get to keep whatever interest income they receive on that. So every 1% rise in interest rates in Australia will add about $3.5 million of profit to their bottom line. And a company that makes 25 mil of NPAT, that's quite material. So, we think that that's another one that will benefit from that. And then there's a few other sort of takeover plays in the market that we like, and that, we're playing. I think there's going to be a lot of M&A. I think when economic growth is slowing down and companies are looking for growth and they can't get it organically, then they start looking at M&A. We're seeing that accelerating at the moment. And the good news is that corporate balance sheets are the healthiest they've ever been in the last 40 years. So this is not like the GFC 2008, where companies were really levered up and then there was a crisis and everyone had to raise money. This is the exact opposite. Everyone's got too much cash, and they will see a significant amount of M&A. And if you're in the right company and there's a bit of luck there, then I think you're going to benefit from this.
Yeah. Guys, we might open up for questions from the audience because there's a few there. So a question maybe for you, David. There's been a real material switch from growth to value in the last few months. Do you think the current market conditions will continue to be supportive value type stocks? And if so, what are your number 1 or 2 picks in the market?
Yeah, I mean, it's been pretty tough for some of the value stocks as well, to be honest, over the last 12 months. And obviously, so I would argue that some of the growth stocks are even coming back down as I think the questions come from. Who did the question come from, Nev?
From Tony Mosquito. Yeah.
Yeah, from Tony. Yeah, I just think it's really, again, just boils down to, the central banks, I think, are backed into a bit of a corner from a macro level. We need to go through that 3 to 6 month period, as Rudi was saying, where you actually need for some of these earnings and some of the outlooks to flow through, and then let the sentiment come back to the market for some of these growth stocks to come back in play again. But I think, you will get rewarded for buying some things at the moment. Some of those growth names that have been sold off so heavily, where they are below cash, or where they're, there's some instances where there's a few companies we're looking at the moment where they're trading, they've come back, they're almost going into cash flow break even this half, and they're trading at sort of 0.7 times recurring revenue. So I do think there is a bit of value starting to emerge now from the growth sector, that a few things that have been beaten up, but I would avoid sectors and companies in particular that still are quite heavily reliant on coming back to the capital markets to support their growth. So there are a few, there are a few businesses that I would think would be going through some tough conversations at the moment. I think Steve might have alluded to it before, particularly in the private space, where, if you haven't raised money over the last 12 to 18 months and you come into the market now to shore up your balance sheet, I think obviously that's going to be a pretty difficult to ask over the next couple of months.
Yeah, and just on that point, just about restoring the balance sheet. I mean, back in COVID, we were waiting for the market to really, fall, and then, to really store the balance sheet. Here, it's really an investor's market. It's a buyer's market. I mean, the conversations we're having, with CEOs, that if you haven't strengthened your balance sheet in the last year or two, you're coming into headwinds, and really, we're coming in with very, very big, steep discounts with 1-for-1 listed long dated options. So it is a buyer's market. On that point, I wanted to ask a question from Julie to you, Rudi. Is this a typical bear market? None of the historic correlations seem to be playing out. Bonds versus equities, gold, inflation, never seen such a confluence of factors to grapple with. Your thoughts?
Well, it's not typical, but it is a bear market. I think a few things to point out here. The first phase of the bear market, we priced out the exuberance that we ended last year with. The second phase we had was basically a de-rating on the back of higher bond yields. But I do think that a lot of people underestimate what is yet to come. And what is now coming is the de-rating in earnings. And just as an example, Mike Wilson at Morgan Stanley thinks that earnings will come down in the US by 20%. In Australia, UBS has just issued a report where they predict that earnings will go down on average by 20%. So that 20% is a lot. If you put 20% lower earnings on a lower multiple, the share market can go a lot lower from here. And I think the other thing I would like to say is, in addition to that, I think what we're going to see is the return of the confession season. And that essentially has already happened. We've seen over the past week, we've seen Evolution Mining, we've seen Northern Star, we've seen Vermilius, we've seen Dacian Gold, we've seen a couple of other companies. So far, they're all small companies. But by the time we arrive in August, a lot more companies will have issued profit warnings. And that's why I think that's the challenge in this bear market. It's not simply trying to pick companies that look cheap, but you have, in my view, if you want to reduce risk, you have to try to have a portfolio that hopefully doesn't get too many profit warnings or disappointments in August. And that's the challenge here. So I think in terms of, is this a typical bear market? The question whether it's going to be growth or value is very much going to rely on, are these companies recession proof? Can they withstand a consumer that temporarily or otherwise, is going to retreat from spending, governments that will be absent, and companies themselves that are going to lay off staff and will spend less. And so what I've been doing since the beginning of the year, I've gone really conservative, and I've concentrated the portfolio around companies like an MCOR, for example, like a CSL, a ResMed, in the technology space, which I'm still in, but I am with companies like an Iris Technology, for example, or Technology One, companies that will withstand a recession if it's around the corner. Mm. And if the recession doesn't arrive, it will be a recession scare, and it will be a recession in earnings. And I think people have to realize that if we do move into a recession, and Macquarie, for example, puts the chances of a recession at 60% for the year ahead, then value will have a really tough time, because the value segment of the market needs economic growth. If economic growth falls away, it's very hard to see value outperforming growth.
Rudi, just on that point, I mean, you raise a really valid point about pricing power. And I think those that are listening is really important. You have to ask yourself, the companies in your portfolio, do they have the ability to increase interest, their prices? And do they have pricing power? And you saw that with KFC and Collins Group just yesterday or the day before. There was an article in the AFR. Price increases of 3 times, right, for your Zinger burgers and your chips, but revenues are still up. So those strong companies like the Coles or the Woolies or the Wesfarmers or the ResMeds or the Irises or the Amcors do have the luxury of increasing prices without impacting demand. So that's a really, really interesting point. The other point as well, I do agree but disagree with you a little bit, Rudi, in terms of I don't think we'll head into recession personally. That's just my view. I think a lot of the bad news is largely factored in. So investors that are listening probably need to ask yourself how much of the bad news is already factored in. I mean, the market knows that interest rates are going to go to 3.5%. They know that inflation's at 10%. They know that things are going to get high. They're going to know that the earnings are going to fall. A lot of that news I feel, is largely factored in. Are we at a bottom? Probably not, but I don't think we're that far away. The biggest risk, absolutely, is that earnings and that revision. Steve, just from your perspective, just from the private side, what are you seeing there? And what are you telling the CEOs and founders? I know we talked a little bit about capital and strength, but in terms of if they do want to go to the market, if they do want to IPO, if they do want to trade sale, what are you seeing, being also in the heart of it in Singapore right now?
Yeah, I was going to say, I haven't heard anyone mentioning about going to IPO recently, funny enough. So typically, I'd say from a capital raising perspective, you're finding that, as I said, a lot of the venture funds are now either they're doing one of 2 things. They're waiting, or they're just supporting their own portfolio companies, and they're making sure that they've got the capital that they need for at least a 3 to 4 year period. The second part is we are seeing more active investors looking to come back in where they can actually add value to some of the private companies in some way. And the reality is, for a lot of them, they realize that if they're getting into companies that are 5 times revenue, they've still got memories of when companies were at 20 times and 30 times. And obviously it was so more in the US where they were sort of that 100 and 200. So for a lot of them, the comments are, yes, they have been sitting on the sidelines, but part 2 of that equation is that there's an incredible valuation arbitrage that can come down the line over the next 2 to 3 years, because effectively you've got some big factors taking place, right? And we haven't discussed about this. Talking about the wealth change from baby boomers to millennials, with millennials now suddenly becoming the most dominant in the workforce, and also with that transfer of wealth going from them. Then you've got factors such as the adoption curve with a lot of the innovation technologies. So to me, I still believe, even though capital has been coming out of the market, you're still going to see great growth in a lot of good companies because of the adoption trends. And also you're going to see that, companies are going to survive without the massive amount of employees that they previously had, and they will adapt to that new environment as not sort of overstaffing their businesses. So, if you take a bit of a perspective, sort of leaning out towards 2, 3 to 5 years, this could be an incredible opportunity for investors in the private and in the venture space, because number one, the valuation arbitrage. Number two, the actual demographic factors that are taking place. Number three, the adoption curve related to a lot of the key technologies that are starting to take place in this area. And then just generally, assuming that, in 3 to 5 years' time, markets sort of come back to themselves. So they're the two dynamics that are actually taking place right now, as far as in the minds of the different investors we're speaking with.
Ron, question for you, and I know we touched about it. Question from Albert. I mean, how far this time to the market correction will go? Can you predict when the market will turn around? And if you do have a potential turnaround, what signs should we be watching for? I know you talked a little bit about the VIX, the volatility index. You talked about essentially the earnings and the margin. So just talk us through the signs that you're seeing for really the bottom, and then which sector in the ASX should we need to closely watch?
Yeah, sure. Look, I definitely tend to agree with you, Niv, that a lot of bad news is currently priced in. I think we talked to a lot of the high net worth investors that are investors with us, and everyone is super bearish. So I think that definitely that sentiment is being reflected at the moment. And then I think, as David mentioned before, this has coincided with probably the most aggressive tax loss selling period that I've ever seen in my career. Just that sort of confluence of events, the first half of the financial year being quite profitable, and then this half being a very highly loss making. I think that it's funny, but this is a kind of market that I was mentioning today, that bad news is good news and good news is bad news, right? And it's very data driven, and every month we're going to get retail sales, we're going to get inflation figures, we're going to get an interest rate decision, and the market is a certain expectations, and if it's above or below the expectations, that's how the markets will react. So I think the problem is that if you get like a good figure like today, for example, retail sales are strong, well, guess what? Central banks will have to raise interest rates higher, so that's bad for markets, right? But if we're going to get a bad reading on the economy, and I think there's a Q1, I think there's a Q2 GDP figures in the US coming out there this week, and some other figures, So to me, we just got to keep watching these figures, and basically the market will react off the back of that. But at the end of the day, where I agree with Rudi is that we haven't bottomed yet, because we still don't know how high interest rates will have to go in order to sort of dampen sort of that inflation figures. And the issue with inflation is that interest rate is quite a blunt instrument. It can sort of taper credit growth, it can reduce consumer spending, but it can't force Putin to attack, stop attacking Ukraine, for example, which is obviously causing energy prices to go up, which is one of the biggest inputs into the inflation metric. And then we've got other issues. China, with their COVID policies, causing supply chain bottlenecks, and the border closures of the last 2 years has caused a real imbalance in international labor flow, which is why we're seeing these labor shortages around the world, which is causing wage inflation. And so there's all these issues that I think are not going to be controlled quickly with raising interest rates. And one more point to mention, I mean, even if the current sort of elevated prices of everything remains for another 12 months, well, we're not going to have an inflation issue in 12 months, because it really measures the rate of change in prices over a 12-month period. So, if elevated prices kind of stay where they are for the next 12 months, I think that will kind of solve part of the issue in a way. The risk is if it keeps going higher in 12 months from now. So I think, I think, like you said, I think sentiment is bearish. I think we're closer to the bottom, but I don't think it's there yet. And, it's very hard to kind of, pick any sort of specific metrics, like I mentioned before, that will tell you this is the bottom. I think you just got to be a bit conservative, have enough cash, invest in companies that are profitable, paying you good dividends. And, I think at some point we'll know when the bottom is, especially when central banks sort of start slowing down in terms of raising rates.
Niv, can I pick up on this?
Yeah, sure, of course.
Just in the extension of Ron. I mean, I think the most important thing that is keeping equity markets here in a bind is inflation, and therefore central banks. So I think we need to see inflation start coming down and the market starting to believe that the central bankers are achieving their goal, which is basically reining in inflation. And then the central bankers probably have to start thinking about maybe we have a pause in our trajectory. I think those are two essential elements before this market can form a bottom. The other question, of course, is if we are facing a 20% downdraft in corporate profits in the US and in Australia, how can we have a bottom unless we have gone through that? So we at the very least, we have to have an August reporting season, and we have to have earnings expectations by analysts that reflects the down 20%. Otherwise, we continue going through this negative cycle in forecasts, which will always weigh on equities.
And just to add even further on that, I think investors are, obviously looking back at what's happened over the last 12 to 24 months. But what happened in COVID was a very different market sell-off to what is actually happening today. It's very different market forces. And so I think looking for a turnaround over the next 3 to 6 months is going to be quite difficult. I think what you've got to do, particularly in the growth equities end of the market, is look through what are the companies that have strong balance sheets, what are the companies that have a product that's going to stand through and provide a real strong value proposition and pricing power. And you've just got to go, your investment horizon just needs to be a little bit further, because it's not going to be a V-shaped recovery. There's no catalyst or something that's going to happen in the markets over the next 3 to 6 months that's going to suddenly drive it back to all-time highs again. So I think we just need to let this period wash out. As I said, I think some of the supply side issues have come through already. People are very aware of what's happening on the supply side, on the inflation side, in particular pockets within there due to macro events. But then the demand side hasn't really flowed through yet. And we've only really just had hikes and very hawkish comments come through from the central banks over the last couple of weeks. So I think that's actually needs to actually wash through the system from a demand side, and then that will also ultimately have an impact on the inflation numbers coming through as well.
Guys, we've probably got another 5, maybe another 10 minutes left. Just want to talk more specifically about sectors. So there's a few questions sector specific. So David, just give us a 1-minute overview on your views on uranium.
Look, pretty positive. I mean, we're very bullish on the energy requirements over the next 10, 20 years. And I think uranium will definitely be part of the makeup for that. So overall, pretty bullish on the uranium sector. I think a lot of investors are looking at it from an Australian lens, but if you look at it from a global lens, you're starting to see Japan come back online. You're starting to see some of the other countries come back online. Europe, obviously China's got a strong nuclear sector as well. So I think it's just going to have to be part of the mix. The energy requirements are just going to be enormous, and batteries are going to get there, but it's the green technology is going to take some time to filtrate into the market properly. So
on that point, I mean, someone in the audience asked, what's my favorite stock? We actually do have an IPO that will list over the next month. It's called T92 Uranium. It's got 3 assets in Athabasca in Canada, an all-star management team with the founder of Alligator, the CEO of Cameco Australia, and NextGen with a 2.2 million enterprise value. So if you're pricing it right with a good assets, good management, one to keep an eye on. Steve, cryptos, tell me more about your views. What's your view on crypto, the crypto market? What assets are these cashed up? What impact is that having, and what you're seeing there in Asia right now?
It's funny, I noticed there's only like 1 or 2 questions related to crypto, but I imagine at least sort of 70 to 80% of sort of everyone on this call has some type of crypto in their portfolio. I think the best post that summed it up is actually something from John Henderson from Airtree today, where he posted in December 2020, maximum greed was at when crypto hit 20,000. And now it's at maximum fear, where it's back down at 20,000. I think it's interesting to watch crypto go through its different sort of crypto winters and then into its bull market. Effectively, we're seeing, the conversations that we're been having is that investors are now just looking to go back to Bitcoin, Ethereum. Definitely, it's not altcoin season at the moment, that is for sure. Obviously, the different fears around some of the DeFi platforms that have had their issues, and obviously there's concerns around withdrawals of Tether, because really no one's really properly ever audited Tether, and that's probably the sort of known unknown from the markets for the last 4 years, is that what is actually backing that thing. But really, look, Bitcoin goes through its halving cycle every 4 years. The last time was in June 2020. The next one will be in sort of May, June 2024. So effectively, anyone, most of the high net worths that we deal with would have been buying or would have been going into digital asset funds or would have been buying their Bitcoin, Ethereum during the crypto winter. And a lot of those said they've done 5x and 10x, even with the markets at where they're at now. And that's what I find really interesting. So, it's obviously, if you're taking a dollar cost averaging approach to it, that's probably sensible, but it's just definitely at the maximum fear level. And yeah, it could go back down. Bitcoin could go back down to 15,000, 10,000, who really knows? But I don't, it's one of those things where people still make the commentary, and, Bitcoin's got its own obituary page about how many times it's died, and it still hasn't. But effectively, momentum's still growing. There's still there's an incredible amount of projects that are still being built on different blockchains like Solana, etc., and obviously Ethereum as well. So it goes through its winter phase, but just be sure to be on the lookout for the sort of 6 to 12 months in the lead up to its next halving cycle.
Ron, probably a question for you as well. EML, what's your views? What are you doing there? And also another question, I know we talked about buying, right? But what are you selling in the portfolio?
Yeah, sure. What I would quickly just say about crypto, I take a bit of a different view to Steve on it. But, if you look at just before pre-COVID, Bitcoin was about 2,000 US. It's around 20,000 now. I think we hit a low of 17,000 recently. You could argue, sure, there's a lot more sort of money that has flowed into it. But you could argue that another sort of metric of a bottom is for Bitcoin to kind of come back to that pre-COVID levels. Now, it might not go back to 2000. Sorry, Steve. But I think it could definitely go significantly lower. In fact, I'm quite surprised that it's not significantly lower, which could be the reason why gold hasn't performed in this inflationary environment, because a lot of that money has gone into Bitcoin. But in terms of EML, look, EML Payments is actually an interest rate beneficiary because they hold a $2.5 billion float on behalf of their customer accounts, and they get to earn interest rate on that and keep that in Australia, the UK, Europe, and North America. So every 1% interest rate rise across those regions adds about $15 million of profit to their bottom line. So they should benefit, make real money profit out of this rising rate cycle. The issue is they've got some operational issues. So obviously that Central Bank of Ireland has put a bit of a cap on how many sort of programs they can launch in Europe, and that has limited their growth. And on top of that, it added a significant amount of cost base to them. So I think they're going to have a bit of a tough year even next year. I think interest rate income will benefit them. I do think they are a potential takeover target. I think a lot of the bad news is priced in, but there is a 10% short interest in the stock. And, you never want to fight the shorts in this market because they're probably going to win. In terms of how what we've been selling, so I think that going into towards the end of last year, we pretty much exited all of our sort of kind of like tech names that were kind of break-even, loss-making. They did really well back then. We could see that kind of that momentum has shifted. And we're really focusing, like I said, companies that are either going to benefit from this environment. We're looking for, businesses that are going to pay us really good dividend yields. And to some, aspect, I think, I think it's hard to say that any business is recession proof. We don't know exactly how it's going to hit it. I mean, it might be able to increase prices, but it might have cost issues as well and all kinds of things. But I think that, businesses that are cheap, we think they can keep growing, paying us good dividend yields. I think they can kind of maintain a bit of a floor in terms of the valuation compared to other businesses that are loss making. I mean, you could argue that the zip monies of the world, they're down 90%, but are they really worth anything if they're losing money in this environment? So, we want businesses that are at least going to pay us a good return. And we do think that this is kind of like a 1970s style period. Maybe not as bad, but we don't usually invest in resources, but we do like the energy sector. I think especially coal and a little bit of oil, but mostly coal and thermal coal. I think there's an energy crisis at the moment, and I think that at the end of the day, the shift to renewables around the world has seen significant underinvestment in new coal supply and even oil supply. And at the end of the day, we need it. And I think those businesses like New Hope and Whitehaven are trading on 1x profit. So I think higher prices are going to stay here for longer. So that's kind of how we sort of adjusting the portfolios.
One more question to Rudi, and it's about property, and then we'll probably end it off, gents. But will the Australian property market potentially have an effect on the share market? 79% of current fixed home loan, which is 32% of total loans, won't see home loan payments increase until January 2023. What are your views on property right now? Where is it going, and what impact will that have on our stock market?
I think property is globally is the big challenge, I think. And it's anyone's guess. I mean, the opposing views we now have in the market is that consumers will keep on spending as long as they can, which essentially means they will tap into their savings. Now, if you take that view, then all the discretionary retailers on the ASX are a great buy here. If you think that the property market in Australia will drop by 20%, and there's quite a few economists around it that put that number forward, and that's usually constructed like 5% this year, 10 or 15% next year, and then a little bit extra in 2024. You come to 20%, that has to have an impact on consumer spending, without talking about people defaulting on their loans and all of that. So that loss in spending will reverberate across the market. And if you start looking at the correlation with the housing market, even the car sales, for example, are very closely correlated with the housing market. So I think that, in essence, is the question mark, both for the US economy as for Australian economy. And we spoke about the recession earlier. We don't need a recession. A 20% house fall will probably create a recessionary environment. If I had to pick a recession, I'm thinking Europe, UK, that's almost guaranteed a recession. And that's also something to take into account when you own companies here that may be big in those regions.
Rudi, Ron, David, Steve, on behalf of us, I want to say thank you very much for joining. For everyone at home, thank you. This will be recorded. For those that have more questions, please direct them directly via an email or via text. We'll answer them. And just want to say thank you very much for all the panelists. It's obviously an interesting environment right now. And thank you very much for all joining. So have a great night, and we'll see you guys all very soon.